Howdy, Jacob here. Today we're going to do a more in-depth analysis on company TDCX, company 118 of our high ROIC screener. When we did our initial analysis, it came within 10% of the buy price, so I looked through the most recent quarterly reports in 20F to come up with some notes. First, I want to go over a general overview of the company again, and then go through some of the notes that I took away to maybe be some things that you think about before possibly investing in the company. And then I'll redo my analysis to see where I think the company is after doing my deeper dive. So, huge return on invested capital, low PE currently, $1 billion market cap on $683 million enterprise value in the commercial services and supplies industry. Looks like they deliver customer experience information data to different types of companies, internationally, so really all over, and they have increased revenue very impressively, but it is declining. I will say that they've increased their earnings per share less than their revenue, and it's not necessarily due to growth of shares. So I guess here you can see that from 2018 to rolling 12, it's probably about equivalent, but I do think it's interesting. I know a lot of companies, it's easier to increase that earnings than their revenue. And that just means the company's becoming more efficient as well, which is a positive direction, which we don't necessarily see here. But very safe balance sheet, $288 million cash on hand, $27 million short-term investment with $86 million total liabilities, no short-term debt, no long-term debt. Balance sheet has great production of free cash flow with the use of cash being a little bit of debt repurchase, share repurchase. And so if we go through some of the notes that I wrote down, I see that revenue outside of the top 5 clients is growing and has been growing quite a bit recently, so much so that it was actually 45% from 23 to 22. The top 5 clients do still make up 76% of revenue, but they do have 97 client count. So basically, we're seeing that their top 5 clients make up a hefty amount of their revenue, but they are really trying to grow their client count so that they're not so centralized, and losing one client would, take an arm and a leg from them. So I do like that they are expanding, but currently 5 clients making up 76% is a huge amount. Their CEO and founder cares about revenue, profit, EBITDA, and increasing client count, which if you read their quarterly report, you can just look at some of the things that he calls out of the most recent 4 to 8 quarterly reports to get a good idea of what he's looking for. Client count is up 15% from 22 Q4 to 23 Q4. Revenues outside the top 5 clients increased 44% year over year. Top 5 clients make up 73% in 2023 compared to 81% in 2022. Their 2 largest clients are Meta and Airbnb, which accounted for 55%. So their 2 largest clients are 55%. Meta and Airbnb. That's a large percentage focusing on just 2 individuals who are just locked into year-long contracts. And they said that usually, it's pretty common for them to just renew it since they're not the only customer experience company working for them. So Meta and Airbnb will have them, maybe SurveyMonkey, maybe 2 to 3 other customer experience companies. So they're not fully relying on one. But that's still a big chunk of revenue coming from just those 2. Revenue was actually down 0.9% year over year from 23, full year 23 from 22, but profit was still up 14.5%, so they were being more efficient, which you actually saw in their employee expenses. So what that meant was just their share-based compensation, I believe, was a little bit lower by 20 million, 15 million or so of the year. Their 23 Q4 was actually down 10%. So they started the year up in Q1, 8% year over year, and then went, I think, 3% year over year, then negative 1% year over year to negative 10% from 23 Q4 or 23 Q4 from 22 Q4. Their shares outstanding have actually decreased about 0.5% year over year, and they've repurchased about 0.2% in 23 Q4 specifically. So they are starting to repurchase shares. That's a possibility of use of cash for them. There are 4 service revenue types that they describe and call out and put their revenues and earnings in place of. And it's omnichannel CX, sales and digital marketing, content and trust and safety, and then other. Omnichannel is the largest, then sales in general, then content, then their other. Their omnichannel actually was only down 2% year over year. However, their sales and digital marketing, which was 27% of revenue, was down 12%. Their content and trust and safety was down 37% year over year. And then the only one that went up was their other, which increased 21%, but it makes up just 1% of the business. So big increase, but it's not enough of the business to really make a dent. They're definitely exposed to some currency fluctuations. A lot of their business is done in US dollar, Singaporean dollar, and they do business globally. So just wanted to point that out. Not good, bad, or ugly, just pointing it out. And then from their 2022 20F, because their 23 20F was not yet, we derive at least 90% of our revenue from new economy clients, and we typically are not an exclusive service provider of our new economy clients, as they prefer to engage more than one provider. So this is what I was saying for Meta and Airbnb. They have multiple different customer experience solutions companies to where they're not fully relied and concentrated on one particular company. And so I'd say that's actually a positive for them due to the fact that, Meta has multiple customer experience, and as long as they're doing well, as long as TDCX is giving great customer experience advice, they're probably going to keep them and possibly even expand beyond whatever. But it just makes it more competitive because you're working, or Meta has, I don't know how many, but 2 to 5 customer experience people to where you just got to outperform them so you're not the one getting fired. Their founder and CEO has 98% of voting power, 85% of total ordinary shares, and he's just 58 years old. So this is just to say that I've definitely done videos where the founder and CEO was like 80 or something. And obviously we know Charlie Munger lived till 99, but here a lot of people, I don't know whether they would work that long. And so here I'm just saying he's only 58 years old. He's the founder and CEO. I think he's going to be there a little bit longer. If you own this company, you really don't have any voting rights since he owns 98% of the voting power. But it's a positive in that he's probably going to do what's best for the business because he is very invested into this business with a lot of his net worth. And so he's trying to get those shares to be increased in value as much as possible. 2022 and 2023, they only used 40% and 42% of free cash flow, the rest going to increase cash balance. So this is what I was saying was kind of weird. And we can actually see it here too. They made, you can't see it as much here because they issued a bunch of shares, but let's look at here. They made $104 million, and then cash on financing was negative 37, issued, repurchased debt 27 million, share repurchases of 10 million, which is 37, 74, and they had 104 million. So you're leaving about 35% out. Here we have 88 million, and they used 45 million, which is just over 50%. So it's not a lot of data to work with because they just went public, but it is interesting to see a perfect company is a Tencent or an Amazon to where they just go down the list. Like, what's the highest return I can get on the money that I can invest back into the business? Then they, invest $1 billion there. And then the next thing, and $3 billion left. Okay, I can't get 25% anymore. What about 20%? Anyone make 20%? And then they go down the list. They don't want any money left over because they're reinvesting everything they can back in the business, or at least paying a dividend. They're not paying a dividend, but some businesses, it does make sense, I guess, to pay a dividend when there's nothing else to do with the business than to keep it in cash. Because if you keep it in cash, that cash is making 4 to 6%. It's not anything impressive. So if I do my new presumptions here, all I did was I decreased the revenue change due to the fact that year over year, it's actually down 1%. I don't think that's going to hold. I do think that it's still such a young company. There's still a lot of room to grow. I minimized the margins just 1%. And then due to it being advisory shares now at the Cayman Islands, I think that those type of companies just kind of don't deserve as big of a premium since people are more scared of them and everything. And then we get to a final price that needs to fall 45% before we get to the price that we're looking for. But I do hope that you enjoyed the analysis and think about some of the things I said, and have a great rest of your day. Thank you.